Let's talk about high cost mortgages and how they relate to conforming loan amounts and what that even really means. But let's make sure we understand what it's not. A high cost mortgage isn't a mortgage person just saying, "Oh, I'm going to charge you a whole bunch of money because I don't like you." That's not the case. A high cost mortgage is an actual technical mortgage term. And what it means is that somebody's buying a house in an area where that housing area is just really, really expensive compared to the rest of the country. So those are high cost mortgages where, like California, like here in North Texas, I'm in Dallas, we don't see that. Like we don't have in all of Texas at the time of this taping, and most of America, truthfully, there's not a lot of places to do the high cost loans. It's usually going to be, the coast of California, or at least Southern California for sure. Maybe parts of Colorado, whether it's Denver or some of the really fancy mountain resorts. Seattle certainly can be one, and then little parts of the East Coast, and on occasion, maybe like in Miami. I think it kind of comes in and out. So just understand it's in like the really expensive part of the world, or of America at least, that these high cost loans come into play. So what are they? They're essentially just a way of saying instead of doing jumbo financing, because these houses are really, really expensive, instead of going to like have to do jumbo financing, which is oftentimes more expensive and harder to do, Fannie Mae and Freddie Mac, the agencies, if you want to call them that, Fannie Mae and Freddie Mac, they basically say, hey, look, in these little pockets, we'll allow or we'll buy Fannie and Freddie, we'll buy these mortgages, and you're allowed to treat them like quote unquote normal. And so it allows for maybe lower down payments, a little better rates, things of that nature, and you avoid the jumbo financing to help people become homeowners in those really expensive areas. So that's what high cost loans are. Conforming loan amounts, they do get set. Often they do change every year. Used to be like when I first started my career in the early 2000s, man, it was 417,000. It sat like that for it feels like a decade. And then eventually, as house prices go up, they would start changing. So in the last handful of years, every year they keep increasing the conforming loan limit to avoid jumbo financing. So as housing's getting more expensive, the loan limits come into so that normal, air quotes, normal conforming loans are easier to get because the balance keeps going up. But these high cost loans, I'll be honest with you, they're you got to check to make sure you're in the area for them. They can change, they will change annually when the conforming loan amount changes. And the part I would say is just make sure you're talking to something like call the mortgage mark team. We'll walk you through it. And if you're going to get one of those loans, we'll make sure you know that because again, these can be hit or miss. And I'll raise my hand and say our company included, all companies, because as a company, the mortgage industry regulates like how many high cost loans you can do. So, for example, if a mortgage company is strictly in California, Southern California, it's a smaller mortgage company, that's all they do, they're probably not going to have a very big capacity to go do a ton of these loans because it's regulated to a percentage of your overall loan portfolio. So, for example, a nationwide company, and I'm working for one now and I have in the past, a nationwide company, man, they love like having a lot of the middle of America loans because it just helps them with their average loan amounts and all this other stuff to diversify. But if they do a bunch of mortgages, they're not doing all the middle of America. They're not doing any high cost loans in the middle of America, right? It's usually on the coast and on the East and West Coast. So it allows them to do more high cost loans on the coast when we're doing more loans in the middle of America and creating a bigger piece of the pie. So I would say do be an informed consumer, right? I will always tell you, like we encourage folks, like go ahead and shop. Like we know we're really good at what we do. But on these high cost loans, if you call us, we're going to say, hey, look, here's where we are. Feel free to make one or two more phone calls and let's just make sure we're where we need to be. And I can't do anything about it. If our rates are higher because we've already hit our limit for what's allowed, they're essentially going to turn it off, right? And turn off the program, air quotes, just means they're going to make the rate so high that the business won't come in. So we typically know when that happens, but I am throwing it out there in case you're not using us. Do an extra phone call or two if you're doing a high cost loan and just make sure you're getting what you think you should be. Obviously, you're always welcome to reach out to us. The Mortgage Mark team will take very good care of you and answer all your questions, whether we're doing the loan or not. And as always, we appreciate you. So forward, share, subscribe, all that fun stuff. And when you think mortgage, think Mark.